Thank you, Bill. And we're good to go, Vanessa?
Yes.
Thank you. Well, ladies and gentlemen, good morning and welcome to everybody. We're going to call to order the quarterly, regularly scheduled meeting of the Lawrence County Retirement Board. Today is Tuesday, June 11, and it's approximately 10:45 morning. Want to note that the meeting is being live streamed and recorded, and would also ask if you have any type of communication device, if you could put it on silent or vibrate, we would appreciate that courtesy. As we note at each meeting, state law stipulates that the county pension fund board or retirement board consists of 5 permanent members, the 3 elected commissioners, the elected county treasurer, in this case Richard Rapone, and the elected county controller, Mr. David Prestipine. We've also noted that Commissioner Kennedy currently is on medical leave, but we anticipate his return in the near future. So we do have a quorum. As long as there are at least 3 of us here, we can conduct business. So we always start our meeting with the Pledge of Allegiance, and if you'd remain standing, by the way, we did this at our commissioners meeting, and I would ask we consider it as well here when we have our moment of silence. We did lose a longtime employee last week. Mr. Joe DiNardo passed away very suddenly. Ask that you keep his family and friends in your thoughts and prayers when we have our moment of silence. Mr. Rapone, could you lead us in the pledge?
I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
We'll have a brief moment of silence, please. Thank you. Vanessa, could you call the roll, please?
Treasurer Rapone.
Present.
Controller Prestipine.
Here.
Commissioner Sinata.
Here.
Commissioner Vogler.
Here. Thanks, Vanessa. We always have time during our meetings for public comments, both in a moment or two, as well as right before we adjourn. You're welcome to speak both times, one of the 2 times, or if you're just here to listen, that's equally fine. We do ask that your comments be related to matters involving the county's retirement board. And with that, I'll open it up for public comment. Debbie?
Did I hear there's an extra book for me?
Oh, there it is. Yeah. I'm sorry.
It's okay. Thank you.
There you go, Deb.
It's easy to follow along. Thanks.
You have the agenda, right?
No, I don't.
Oh,
I'll get it. I'll come over.
do we have an extra one? Yeah, there we go.
Thank you.
Any other questions, Debbie, at this
Thank
time?
you. I'm good.
Okay, thank you very much. We have in our packet the minutes of our last meeting of this board, which took place on February 13. Gentlemen, I'll give you a moment or 2 to look them over, and then whenever one of you might be ready, we can entertain a motion to approve the minutes. Thank you, David. Is there a second?
Second.
Thank you, Mr. Rapone. Any discussion or questions about the minutes? Hearing none, we'll do a roll call, please.
Treasurer Rapone.
Yes.
Controller Prestipine.
Yes.
Commissioner Sinata.
Yes.
Commissioner Vogler.
Yes,
Motion carries.
thank you. Well, the primary reason why we get together is to always get an update from Sarah Wilson, who is with Marquette Investments and Marquette Associates, which handles the pension fund's investments. And it's always a pleasure to have you here. And we'll turn the meeting over to you, and you can walk us through the data that you've given us, please.
Okay, good morning, everybody. If we turn to Exhibit 2, we'll go to page 10. And it's very interesting because so much has changed since this has been written. But in order to always understand your performance, you have to understand what's happened in the quarter and kind of what the previous month. So we look at US real GDP growth on page 10 on that chart. And you can see that net exports and inventories detracted about 1.2%. So we've seen a little bit of a mild slowdown in domestic demand compared to the fourth quarter. That was one thing that kind of sparked everybody thinking that interest rates were going to come down. But what we've also seen is that with all the low interest rates, it's saving US households $550 billion a year. Therefore, the consumer continues to spend. So we've got the consumer spending, and then we look at growth and employment at the bottom, and you can see federal and healthcare are leading the way in growth there. So we've seen some fiscal support is evident in government-related sectors. So that meaning that there's support holding up this labor market. If we look at page 11, we will continually, I think, forever go back to COVID. So when we look at that March 21st there, you can see that this wage growth, you had an amazing spike in the wage growth. Well, that was because they had to get everybody back to work. So that spike is also what caused some of the inflation because the employees were getting paid much more. And then we started to see that detract a little bit. So at the point when this was written, we look at what's happening with the Fed, and really this has been a driving force. So we started to see wage growth detract. At the beginning of this year, end of last year, some economists thought, and the market felt, that we could be between 6 to 3 cuts. So they were feeling pretty good going into this market. Then what happened in January, we saw some data come out, and at one point, they thought that interest rates could go up another quarter. So you've had this very volatile market. By the end of March, when we saw the Fed meeting minutes and everything, we looked at maybe they would do a cut in June and possibly in September. Now we know that the Fed meets tomorrow. We're thinking that they're going to keep it probably at the same rate it is, and we may possibly have one cut this year. So that has given a lot of different data, and then we know that bonds respond to that. We look at what's happening with equity. So we've had this very volatile market. Even though we've had an up for the first quarter, we've kind of just gone like this with performance and changing of market value, but we've seen a lot of this within the market. If you turn the page, we know we're a global economy. We talk about what's happening, and actually the global economic growth forecast looks a little bit better. And this will actually do much better for your small and your mid cap, your international, because international kind of, when the mega caps are, really taking off, we know there were 9 mega caps moving the S&P 500. Your small cap and your mid cap and internationally kind of struggle. They also, small cap companies struggle because they have to borrow money, and they're going to have to borrow money at a higher interest rate. So hopefully we'll start to see that change a little bit when we see those cuts. It's interesting, Sweden, however, which is an indicator of, even though it's small, it's an indicator of what's going on in manufacturing. Sweden's had a little bit of a bump. So we see Europe and the global, hopefully the developed markets and the emerging markets just go up a little bit. So they may have a little bit more growth this year. We look at page 13 and we talk about what US equities did. For the quarter, they did 9.9%. For the trailing 12 months, 331 to 331, they did 29.3%. But then we look at US bonds. US bonds were negative again for the quarter. One of the things that you did as a board, you went into infrastructure, which is a nice inflation hedge. You went into defensive equity, and you did real estate. And all of those were funded partly by fixed income. So you're kind of you've lowered your fixed income and getting a little bit more return. We look at what happened with US REITs. We know that we sit there and we see what's happening with real estate. We'll look at your real estate manager. Remember, it's an institutional real estate manager. In 2020, they had to kind of figure out what they were going to do with all of, the offices and everything. So they readjusted. They went into Amazon, you know, like warehouses, they went into storage units and everything. Now we see what's really happening with real estate is they're readjusting again, and they are going into high rental units and actually rental communities. So we're going to kind of see that shift. We know that real estate will eventually kind of come back as an investment. Remember, it's long term. But interestingly enough, with real estate, and you look at it, prices have not come down yet. Usually when you start seeing a lot of interest rates go up, you'll see prices going down, and you really have not seen that within the market as much. And then we look at what happened with gold. Gold was interesting. Usually when you see a market that's returning high returns, people kind of shy away from gold. But right now, we saw gold jump 7%, and probably because of the volatility within this market. And then we look at commodities, we looked at oil. There was a large 17% jump into oil prices for the quarter, so that had a nice return, still not that much. And we know that oil's actually been down, I think it's about 7 cents down last week per gallon. If we turn the page, we look at the sectors, and we talk about, we look at energy, which I said was down, but still provided 13.1. Look at financials, so trailing 12 months, 34.5. That being said, they're getting a lot more bang for their money when they have to loan money there. And then we look at information technology for the quarter was 12, but for the trailing 12 months was 42.8. And then we see what's happening, and growth stocks, top value stocks, once again in the first quarter, over the past year, growth outperformed value by more than 18 percentage points. And what we look at that is we know that when you've got these mega caps growing and continuing to move the market, value is not going to do as well. Now, you know, we take a slight value tilt that has always helped you in a down market. So you'll see it being a little bit off. We especially take a value tilt in international. And the reason why we do that is there's much more volatility there. So we're not as aggressive with our managers, so they sometimes do not outperform the market, their index, but they still do very well there. And then we look at profit outlook on page 15. We go look at U.S. economic growth, and we saw earlier signs of a pickup outside the U.S. and might be an improved profit outlook for U.S. companies. So you look at how that's gone up. And then we look at South Korea exports, which is an open economy, has a long history of signaling turning points in the profit cycle. I do have to say that, you know, when we see acceleration in profits, we see these great returns, we also have this issue of inflation. And then one of the things that, you know, when we look at what's going to happen in the next 12 to 18 months with interest rates, we also need to remember is that, you know, when interest rates were so low, the American consumer borrowed big credit lines, which are variable, and now our credit cards. And so we're going to start seeing that inch back. Even when interest rates go down, we're going to see the consumer is becoming very credit heavy, meaning they're not saving the way they used to. We know there was a savings, the consumer saved a lot during COVID. That was also because they got extra money to do that with. So we're going to start seeing everything the Fed has done. And I think this is why they're becoming much more cautious. Remember, they took interest rates down very fast, and then they bumped them up very fast and did not let the market, the consumer, the economy kind of catch up with those decisions. So we're probably going to see them, as I said, they think about one cut this year, so it's going to go down slowly. And what that means is when we go look at where the market's going, we think it's going to be, you know, a very kind of flat market. I'm always asking, you know, what do we think the market's going to do? We've talked about what it does in the presidential election. Usually you see the kind of market go like this, and you get like a 5 to 7% return there. We know that you have the same two people coming into office, so therefore the market knows what those policies are going to look like. The difference would be is if the House and Senate go all one party. and that will move a little bit on where the market's going on there. You've had a very interesting April and May. We saw the Dow hit 40,000 all-time record. 2 days ago, the S&P intraday trading hit another record. NASDAQ's hit a record. And even with some of those records, the stock futures in the next opening day were down. So even with all of this, you're not really seeing a positive gain. So this quarter, we're kind of in negative territory, even with hitting all of these. And I think because of that, and because of where the economy's going, I think you're gonna probably see for this year a lot smaller return than we did last year. And we know 2022 was really tough because it was a double-digit down for the fixed income and equity. So last year you had a great year, which was really good, kind of boost yourself up to over the 100 million. Had a good quarter, but I think it's gonna be not as easy to have those double-digit returns, and that is why you as a board diversify. Are there any questions on the market? All right, then let's go to Exhibit 3. We'll talk about how you did on page 22. So at the end of March, you were at 100.6 million. At the end of Friday, and I think it's interesting, you're at 100.9 million. So really, you have not seen that much movement within the last couple months of these wild rides in the market. You returned 5.2%, and that's net of all investment manager fees and our fees, and had a net investment gain of 4.9, outperforming the benchmark of 4.9. So you had 4.9 million, and you also had a 4.9 benchmark. So it kind of sounds odd, but you outperformed in an up market, and usually we're kind of right there. And the reason is because there's a lot of volatility. So those managers that we put in place to handle that have done very well. Since inception, you have had an annualized return of 7.6 with a net investment gain of 59.4 million. So that's been great. You've met your actuarial assumption, and that's your bogey. That's the target. If we do anything else, great. But as long as you meet your actuarial assumption, you do it with less risk than the market, you've really done what you're supposed to do as a fiduciary. Positive attributions were defensive equity, infrastructure, real estate, and your fixed income manager. We just put in that fixed income active manager, CS McKee, so we'll look at some of those numbers. Negative was a value tilt within US and non-US equities, which we're fine with. We know that that's done well. And then the non-US equity composite, some of those managers had a little bit of problem. What we did is, we look every week at these portfolios. And then we have research look at all these managers that go in, especially into discretionary, because, we sit alongside with you as a fiduciary. So we looked at Hartford Schroeder International Multi-Cap Value. They were actually performing okay, but they had some changes in shifting in how they were performing, and also some changes in the portfolio management. They weren't exactly doing what we wanted them to do. So we liquidated them and we put them in the Fidelity Total International Index Fund until we find a manager that we think that's going to fit. We don't like to get rid of one manager and then put automatically another manager in. We want to discuss it. We want to make sure it's the right fit. And then we replaced Fidelity Emerging Market Index Fund with DFA Emerging Market Core Equity. So last summer, we replaced Wellington and put it into that Fidelity Emerging Markets. And then we went out and we found that DFA Emerging Markets would fit. Just so you know, out of the 130 employees, were 40 plus employees in research. So that is the one thing that Marquette we think that we excel at, that we really put a lot of resources into research. Last year we did 3,500 meetings with managers and went abroad to do it as well. So, we have them come in and everything. So we always like to kind of make sure that before we put anybody in there, we'll just put you in the index. So you've got that diversification and exposure, but then we'll put the right manager in there for you. Your low investment management fees of 28 basis points, which is extremely low with a very active managed account. And then what we have outstanding is redemption of 2.5 million from real estate manager Clarion. What we did is we took some of the earnings off of real estate in 2022. Real estate just went great. It was the only performing manager that actually had good performance and was in positive territory. So we took some of that off the table, putting you back to target. And then what we're also doing is we changed it to dividends because we're always taking money out. So that dividend, instead of reinvesting in it, we changed it to pay out dividends right now. We may go back in. What we're thinking on real estate is we're just going to watch where the market's going with interest rates there. We like it. It's great investment. There's no need to put more into it right now. Are there any questions so far? All right, let's go to page 30. And we'll talk a little bit about what the managers did. So if you look at the U.S. equity composite, you can see Eaton Vance did very well for you. They're a small mid cap. They did 9.6 versus 6.9. We put them in when we were here. So for the last 10 years, they've annualized 12.6 versus 9.2. They've had great performance. They've done really well for you. When we look at the global equity composite, you can see Dodge and Cox, while they underperformed a little bit for the first quarter, the trailing year, they've done 21% versus 18, and annualized since we put them in at 7.1 versus 5.1. And what has happened with Dodge and Cox is you will see them fluctuate, but usually they're way above the benchmark. They're kind of your alpha there. Artisan, remember we talked about Artisan. So Artisan we put in August 2021. Last year, Artisan had a horrible year in performance. And all of us consultants kept coming back to research, being like, there's got to be something wrong. So we brought them in, we talked to them. They were still the #1 performing manager within their specialty versus that benchmark. It was just what was held, what they held versus the benchmark. So they've done well. It was just the way it was. So, we've had them in a lot of portfolios for a very long time. And you can see for the trailing 3 months, they were at 10.8 versus 9.5, and the trailing 1 year is 25% versus 28. So we're very comfortable with them. You can see they're a little bit negative versus their benchmark. That is just the time shot that you're going to take. And remember, you don't judge a manager until you look them 3, 5, and 7. Even if we've had a manager in there for 6 months, they're not doing what we do, we would get rid of them. Artisan, we have a lot of faith in, they're a very good global manager. MFS, low volatility, did 6% versus 4.7, and then 1 year did 16.3 versus 11.1. So really, when we look at both your portfolios, U.S. equity composite, we know that it's very hard to find a manager that is a large cap value manager that's going to outperform the market, the S&P 500, for what you pay in price for it. So we put that into an index, and then we think that small cap is where you should be active. And then you look at global, you can see that you don't have indexes in there. That's where we really feel that that's where you should be very active in, and that will give you some good returns. Non-US equity composite, we have the Fidelity Total International Index, 4.3% for the quarter. Earning Loebner small companies, and this is just where the market was negative 0.6 versus 1.8 for the trailing year. It did 7.2, and then DFA Emerging Core, you'll see, will have updated performance at the end of next quarter for you. Real estate, you can see, has had a tough year. It was down 2.1 for the quarter, and for the trailing 12 months, 12.3. But you see 3 years, it's averaged 3.1%, and since you put them in, it's annualized 4.3. Remember, we funded that from fixed income and equity. So long-term, and it's also giving you a good dividend. Infrastructure has done well for you. You put that in April 2022. So we've had it for 2 years. It's done 2.7 versus the mark CPI plus 3 at 2.6. 1 year 10.9 versus 6.6, so great performance. And it's annualized 10.5 versus 7.3, so some really nice, and it's an inflation hedge, so infrastructure will do very well in this kind of environment. Defensive equity had a good year. They did, for the quarter, they did 6.4 versus 5.9, and for 1 year, they did 17.5 versus 17.2. If you look at US fixed income composite, and we talk about fixed income, and fixed income has just had a hard time. You've actually outperformed your composite, and even with CS McKee, who's been active, they were only down 0.5 versus 0.8, and for 1 year, they've done 2.9 versus 1.7, and since we put them in, they've done 0.9 versus 0, so they've been even. And then, so fixed income is just really hard. You've annualized in the last 10 years, 1.3% in fixed income. So, you know, when you look at that real estate at 3.1% annualized, it really is not that much different. So you have to have fixed income in there. I know we've lowered your fixed income to 24%, 1% being 23%, and then 0.5% to 1% in your money market. And you can see the money market for the trailing 12 months has did 5.5. So, and remember, it took a while for the money market to actually give you a return. I mean, they raised interest rates, but the banks were not giving out those interests. And so you actually got some money on cash for the trailing 12 months, which is kind of nice to see. I think you're in good shape. If you turn to page 34, you can see the breakout of all your managers and their fee schedule. So again, you're at 28 basis points all in. Are there any questions?
On page 34,
Mm-hmm.
the Fidelity 500 Index Fund is 27% of our portfolio.
Mm-hmm.
Is that fairly consistent, or is that a little higher than it usually is, to your knowledge?
No, it's fairly, actually, let's see. Yep, it's 27% of equities. Now, it's not. When we look at that, you always want your largest exposure to be within US domestic. And the way we do it is the Fidelity 500 index fund. Remember, I said like a large cap value manager. Now, if you put a large cap value manager in, we would take away from that 27%.
But that particular fund, to the best of your recollection, has always been the largest fund in terms of the percentage of the portfolio.
Correct, yes.
Okay.
And the reason for that is not only a performance-wise, is that when we look at the asset allocation, you don't want to have more in global or international.
Right.
It's just going to be a little bit more riskier, and you are overfunded, so there's no point taking more of that risk there. So you're basically saying 27% of your portfolio is going to give you what the market gives you.
Okay.
And long-term, it's fine. I mean, sometimes it's gonna, feel a little bit harsh when we see, the equity market go down, but
Thank you for that.
you're welcome.
Members of the board, I'll start with Mr. Sonata.
Is that the S&P 500?
Yes.
Pretty much where they're at.
Yes, and when we looking at index funds, we like Fidelity, and they're also only 2 basis points, so we thought that was the best one to put in there.
Anything else, Chris? Mr. Prestipine,
No, I'm
questions for Sarah? Okay, thank you. Mr. Rapone?
Yes, I have a question for David and for Sarah. Is that okay?
Mm-hmm.
Okay, David, at the end of 2023, you had reported the economy was 101% invested.
Mhm.
Where do we sit today?
The report right here, actually, this is, just came a few weeks ago, we are at 101.3%.
101.3%. And then Sarah, you had stated that the average vested of your Pennsylvania County clients were 83%.
83 to 86, yeah.
And that still stands.
We'll see what happened after last year. We'll do, we do the PA database
Okay.
report, so we'll be able to see what the average is. But the average is about 83 to 84, and then I'd like to say our clients were a little bit higher than that.
So we're doing pretty good.
You're doing very, very well, very well.
Because if that 83 is the average, obviously there are some counties below that 83 mark.
Oh, yes.
Okay.
There are some counties below that, and then, what we've really seen, by working with all different size of counties across, Pennsylvania, especially I've seen, is that they're really struggling meeting their ABC contribution. You've got, what's the biggest struggle right now is paying employees, a higher wage to be able to get them in, and how the county's doing that, and budgeting, and then, do you really want to raise taxes? So you're starting to see it, be a very, it's a hard thing, because you offer this pension fund, so therefore some counties can't do as much in wage, so you've actually seen a lot of that change. And you do see some counties struggling to meet their ADC payments, and that's very hard. Especially, it's great when you come off of a up year, but when you come off of a down year, that's pretty tough. So you being funded like that, even with 2022 being a down year, double-digit down year, you've done very well.
I appreciate your question, but please, go
Just
ahead.
one more question to that. I would also be curious, out of your clients, Sarah, how many of your clients are fifth-class counties to compare like apples to apples to where we stand? I don't know if next time we meet or.
I can get
Okay.
feedback, and you know what I'll do is, for the next meeting, well, we won't have, I think, did we go over the database last year? I thought we did. I can bring it up, I'll get the PE database, the new one won't be out till the end of the year, but I don't think that many are fifth class. I get that, I will check of our clients, if we have some really, really big ones out there. I will definitely get
Thanks.
you that information.
Again, I appreciate your raising the question, showing where we stand in comparison to a lot of other counties.
Sure.
We're in pretty good shape.
Yes, you are.
We're in very good shape.
That's good. And as for the ADC, in most years, since I've been here, there have been a few exceptions, but in most years, I think we've been able to fully
Yeah,
allocate.
just about every year we have one or two. along the way that we didn't most of it, right? Most of the time we made the entire contribution.
Are there other questions for Sarah on the report that she's given us this
I
morning?
want
Yes,
to
sir.
report. I know the last time we gathered, we had talked about having an informational meeting for the employees. Has anything moved on that?
Yeah, we probably do need to move on that.
I would suggest after Labor Day, a lot of folks are on vacation over the next few months, and maybe sometime in September.
I'll talk to Dave, and then maybe, your actuary from Corn Ferry, and then maybe you and I, while we're at the conference, can sit with him and get like a couple dates. Would that be good?
Yes, and speaking of that,
And then we'll work through you.
this board meets again in September, but I can't find the date. Do you happen to know? Is it always the second Tuesday of the?
It was off because of CCAP.
Right.
Yeah,
I don't know, I have the date upstairs.
okay. If we meet every 3 months, I'm guessing we'll meet again in September
Yeah.
sometime.
I think it's off because we had,
We had the date.
we did because of
Yeah.
CCAP.
Yeah.
Check if I've got it.
And then, would we be like considering 2 sessions, like morning and afternoon? Okay.
And again, I'm thinking sometime after Labor Day. In fact, I'm wondering if it should be after our next board meeting.
It's fine.
Would you be okay with that,
Absolutely.
gentlemen? Okay.
I think, when are we, September 10th?
That would be the second Tuesday of the month. That'd be my guess. Vanessa will double check, but
I think it's September 10th.
yeah, we'll tentatively say September 10, and then sometime after that.
Maybe the week of the 23rd of September.
I
I
know,
have a conference the 15th, 16th. I'll be back the 17th, so I could do the 18th, 19th, 20th. What are good days?
One's even better than the other.
Okay, and then actually, I'm gonna see Dave in the next 2 days at the conference. So what I'll do is I'll get some dates from him too, see if he's open those 2 weeks, and then I'll shoot you an email. And then we can get that.
good. Before I get to even new business, do you have anything else under your report that you need to share with us?
I know.
Okay. And that does then take us, assuming there are no more questions for Sarah at this point, under new business, so far, we have nothing listed, but I do want to go around the table here. Rich, anything you have for us under new business?
No.
David?
The only thing I have, I did bring the actuarial report that we just received a couple of weeks ago. And just wanted to bring up a couple of points. Richard already brought up the one, it's 101.3% funded. The other point on there that the ADC that we contribute every year, the estimate we got last year was at $860,000, which I believe we put that entire amount into the 2024 budget. The actual actually came at $646,000. So it's a couple $100,000 savings from what we have in the budget to the actual amount that's required to be paid.
That's very good news. Thank you for, and ADC stands for,
Actuarial determined contribution.
which used to be ARC.
Yes, it used to be the annual required contribution,
Yes.
but since it's not actually required to pay it, they changed the word.
It's more of a guidance from our actuarial friends. And as Sarah just noted, some counties meet that figure every year, or some don't. We've been pretty good about meeting that figure most years.
646,000 for your size. I've got counties that are half your size putting over $2 million.
Wow.
Yeah.
Okay,
So
that speaks well for us.
it does.
Commissioner Sanada?
It's good to hear. Sarah, appreciate all your efforts.
Thank you.
The important thing is for the employees to have a solid pension. We want to make sure, from our perspective, that happens. And I think, we make the investments now. Like Dave said, Rich, you want to be 100% funded. That's going to save us money. And that's so cool. So thank you.
Will you be at the County Commissioners Conference in Adams County in August?
Yes, I will.
Okay, we'll look forward to seeing you. And it sounds like yours is coming up.
In July.
And where's yours being held?
York County.
York. Oh, that'd be nice. Have you had yours yet?
It's today.
Yeah.
Oh,
Yeah,
oh.
we're going up, this one's going up Wednesday and Thursday.
And it's in,
It's Cranberry.
oh, that's
They're
nice.
driving up, so
Yeah.
we'll see Sarah.
I'm leaving and going there.
Okay, well then, we don't want to hold.
Oh, no, I'm
you
fine.
folks up. Before I get to public comment, Debbie, I neglected at the commissioners' meeting, and I'll announce it now since I at least say it. At 2:30 this afternoon, the West Central Job Partnership Governing Board is holding a brief public meeting. It's a Zoom meeting only. And the primary role of the meeting is to reduce the number of board members on the Workforce Development Board. This is going to be a recommendation coming to the 6 commissioners from Mr. Dogan. I can send you the link if you'd like. So when I get upstairs, I'll forward that to you. That's at 2:30 this afternoon. I apologize, I forgot to mention that at the commissioners meeting. And that'll take us to public comment. Debbie, do you have any questions for either us or Ms. Wilson?
I don't think so.
Okay, thank you. if you two gentlemen don't mind, when we adjourn, I'm gonna run up real quick, and I'd like you to see this letter as well, that I got from West Bank. I'm sure you'll know what it means. I don't know that I do, so if you can just take a second, I'll bring it down real quick. Closing comments from my fellow board members, Mr. Rapone?
Just thank you once again, Sarah. You did an outstanding job for us. Thank you.
And I agree with what he just said. Mr. Prestipine,
I'm good, thank you.
Mr. Sanada? Good as well, thank you. Any housekeeping items, Vanessa, that we've overlooked?
No.
Okay, well, again, we always appreciate the great work you do for us and how responsive you always are. We just always enjoy having you at our meetings.
Well, thank you, of course. I like coming to Lawrence County.
That's your best client.
There you go. Actually, one of my nicest clients. I gotta watch it.
I know, you
But
got
yes, thank you very much. Always appreciate this. And really enjoy what you do.
it. We wish you safe travels. Gentlemen, there being no, Mr. Sanada? I move to adjourn. Is there a second to that motion? Motion's been made to adjourn. All those in favor, please say aye. Aye, opposed, the same sign. Motion carries. This meeting is adjourned. Thank you, everybody. Bless you.
Bless you.